Are you an agent struggling to understand real estate economics? Would you benefit from learning how top agents structure their businesses? Then you've come to the right place. And welcome to another edition of the Nerdy Agent Podcast, where we teach you the basic economic and business principles you need to thrive in today's real estate market. I'm your host, Luke Pettersen, with my brothers and fellow nerds, Josh and AJ. What's going on, guys?
Huge playoff game. Well, should be a playoff game atmosphere tomorrow night at Hopkins High School.
Big game.
The Advisor Realty Group.
Is it tonight or is it tomorrow night?
It's tomorrow night.
Okay, just to be clear.
Advisor Realty Group is taking on basketball team, I believe.
When this
so that's what to beat to make it in? Basketball team?
Two good basketball teams, yes. And one of them is called basketball team.
When this podcast is released, not only will we have won a massive regular season game to get into the playoffs in our rec basketball league, but the Vikings will also have beaten the Giants 100-0.
It's going to be like the Georgia TCU game.
Georgia TCU.
Yeah, totally. That's what we've expected this year.
That gets us to our Would You Rather.
The Would You Rather of the week is a little controversial. We're going to have to make sure that Haley stays in the room to finish producing this episode probably after this Would You Rather. Would you rather have Aaron Rodgers as your quarterback and not be in the playoffs, or have Kirk Cousins as your quarterback and be in the playoffs?
God, it was so fun watching Aaron Rodgers just sulk off the field after.
If we lose, it's going to be a different question because neither one of the teams will be in the playoffs on Monday. But
that's true.
I mean, I like our chances. I think we're looking pretty good. So it's always fun to poke at Aaron a little bit, and we'll see if he's even back next year as their quarterback.
I would take Kirk Cousins and be in the playoffs, if anybody was wondering.
I would too.
Haley was too busy telling me to get closer to the mic to have any emotional feeling about that. Would you rather?
If Kirk Cousins doesn't like have a game-winning drive at the end of the game and then yell, "You like that?" to the media after the game, I'm going to be very disappointed.
We're going to win 100-0. There will be no game-winning drive.
He will say you like that if they win 100-0.
They probably will.
Let's get into the topic of the week, which is the mortgage applications, and specifically how many are being filled out, and the data behind that. We're wondering about the numbers and what that's been like in the past, and then also how agents can track that, why it matters to them, and how you can use that data on a daily, weekly, monthly basis with your clients, explaining what that is, what those numbers look like, to be the expert in the room. To start, let's talk about and give the listeners the basics regarding mortgage applications numbers, and where they can track that data.
Yeah, so the mortgage application data is published by the Mortgage Bankers Association on a monthly basis. You can track it there. Or, of course, we love going to Mortgage News Daily. I know we've pitched that a couple of times before. They have daily interest rates, average interest rates across the country. They have articles talking about why interest rates move this way or that way, and just overall a lot of really good information about rates.
Yeah, they have a super cool graph on Mortgage News Daily, too, that shows they have a double axis graph. So for any nerds out there that like double axis graphs, you'll really enjoy this.
Explain what a double axis graph is.
So on one side of the graph, as you think about where the data is trending, right, it's over time. So the bottom the y-axis is the date, right? So year by year by year. One x-axis is the number of the mortgage index, so the mortgage application index, which is how this is tracked, where that number tracks, and the right axis is interest rates. So you have a line going through with interest rates, and you have a bar going through with the actual applications. So you can see the correlation between them. So like as interest rates go down,
between interest rates and how many mortgage applications are being filled out.
Yep. So like as interest rates go down, you see a jump in the index. As interest rates go up, you see the index come down. So it's kind of cool to actually look at those side by side.
That's really cool data. So if anyone wants to check it out, that's the place to look. And tell us why agents should care to track this data. Why should they be looking this up after this podcast and learning more about it?
I mean, I think what we'll go into in depth and what people already assume and talk about a lot is as mortgage applications increase, buyer behavior will be more aggressive, right? There's going to be more buyers on the market in theory if there's more applications being put into the lenders. So it's a really important track as a leading indicator for what the activity in the buyer pool is going to look like in the future. And historically, as you'll see from the data, if you look back over time, and as we'll talk about, the more applications were filled out, the more buyers were actually entering the market, which means a more aggressive buyer pool. And it will impact how you think about talking to your clients, but also how you see the next year of your business progressing, because it will be very indicative of what's going to happen.
Just firing from the hip here too, I'm wondering how far, depending on how far back that double axis graph goes, you might be able to see some correlation as far as at a certain interest rate, this amount of people jump into the market, right? So like if rates are 5.25, there's going to be a significantly less amount of applications maybe than if they were 5 on the dot, right?
Yeah,
so
I haven't run the R squared on that, but that would be really interesting to see.
Interesting to see because
interest rate, application index, and
so you might theoretically have a better opportunity at 5.25 than 5, even though you have that extra quarter point, but you're going to have significantly less competition. And if it hits 5, they fill out the application, they can't buy a house right away. Whereas if you've already filled out an application when it's 5.25, you might be a little bit more nimble, able to move on something on the market.
Yeah, exactly, right? So if you get ahead of it. So we'll talk about that at the end of the podcast too. I have some thoughts on what the next year might mean, even though the index is in a really low point right now. There may be some things going on that I think could impact how we see 2023 a little bit more uniquely than we've seen in the past.
And starting off kind of on how the mortgage application numbers have looked in the past, I want to kind of go from early 2000s to present. So first off, historically, what were they looking like in the early 2000s?
Yeah, so obviously this is an index, and so it's basically tracking back to a certain date and time. The index start date was 1990. Interest rates were 10% at the time. So that kind of throws things off because the index will tell you basically, 100 would be the exact same as 1990.
The same amount of mortgage applications.
Applications. So 200 would be double. Okay. 300 would be triple. 400 would be quadruple, so on and so forth, right? And because it was such a high interest rate at the time, most of the time we see this index pretty high, from index standards, if you will.
It has not been back at 1990 levels since 1990.
Right. Rates have pretty much come down since then. They've bounced back up and down, but they've never been quite as high as they were. It peaked in 2005 with all the lax lending standards and all that crap that was going on before the big housing crash. It peaked at 493, so almost 5 times the number of mortgage applications as we had in 1990, which is really crazy. But it stayed in the 400s through 07. So during that time period, it was really high.
Interesting, yeah. And then after the
interesting,
very interesting. I didn't catch that.
You're not a dad. You'll get there.
No, I'm not a dad. It'll be a few years for me until I get that joke.
So that will also, to your question earlier, Luke, about whether I will correlate them. The reality of things pre-2008 will impact that correlation if you look over a longer period of time, because the lending standards have changed so drastically following the housing crisis that you won't necessarily interest rates exactly correlated. And
speaking about the lax lending standards, so let's talk about the 2008 crash, everything that happened after that. So because I think that's an important snapshot in time. So like I put 2002, 2012, but kind of in that general time frame, what were they looking like?
Yeah, so essentially what happened is they just point 90 to 2008-ish, it kept going up, right? So 2005 it peaked, but it still stayed like in that 400 range until the crash happened. Then at that point it started coming down. It still stayed surprisingly above 200 pretty much the entire time through the crash into 2010. So even though the market was on fire in a bad way, right? Like it's burning down. You're still seeing more people applying for mortgages than you were seeing in 1990. So that's an indication of how the housing reality has changed in this country. It's really interesting.
Do we think some of that is like due to the fact that there's like more people in more houses, and then there's just more sales then? Like it's just by default, right? I mean, like that's a thing. Like we have more people than
population
we have
growth,
right? More houses on because we've built more.
Right, and we haven't taken many away. We've just been adding them.
Yeah, and if you look at how long people lived in their homes back then, and what age people are buying houses, and then on top of that, we're building more houses every year because our population was growing at that point in time.
There's definitely a ton of factors. I mean, you could also argue like with technology, it's made the move of buying a new house and selling a house easier. Like back in the day, there was so much that went into
pace
it.
of change.
The people in the market didn't even know which houses were for sale when you were looking. Now they all.
It's so funny to talk to people who were agents back then, and they're like, "Yeah, I had to like print out all these sheets and bring them to my clients and show them the book."
We should have Dwight come on and talk to us about what real estate was in the 90s. That'd be so cool. I heard there was literally a book that
can we dress in all 90s clothes for that podcast? Yes. That'd be awesome.
I heard there was a book you drive to a single location. The book had all the listings.
Yep,
it's amazing. I'm gonna wear an Alanis Morissette shirt.
And then when you offered on a house, the agent went to the house and presented the offer to the sellers.
It's phenomenal.
In person.
Yeah, all together.
Yeah, it's so good.
It's wild. But one more story there. I talked to an agent. He said I used to print out multiple different offers so that when I would of potential for buyers, and sit outside and talk to them about it, so that if they changed their mind on which offer they wanted to go with, I would have the different offers available at that point in time. So I didn't want to go back to the office and print more offers.
It's so funny.
Anyway,
That's crazy. So that's 2000. That's just
oh
after
no,
the crash.
so the index, yeah, so right at that point. But then we saw basically from that point forward, it settled in like the 200-ish range, maybe the high 100s, and then it slowly came up all the way up until COVID. So we kind of saw it continue to go from like 180 to 200 to 220 to 240 to about 260 in the COVID range, and then that's when everything kind of got weird in the last 3 years.
So talk about COVID mortgage applications. Then you kind of touched on it a little bit, but where were they? They picked up and kind of run through what that's looked like the last 2 years. outside of COVID.
So like everything else during COVID, the immediate impact was real, right? So people freaked out overnight. It dropped really quick. So it went from 260 down to the 180s. But then when people realized things were probably going to be okay, the interest rates were so low that they thought they could do pretty well. We saw that number continue to come back up and actually hit numbers that we hadn't seen since the housing crash. So it went over 300 for the first time since 2008. And then the low interest rate environment just kept on overheating that market. We saw a lot of activity and competition, as well as price appreciation. So that 3-year span was heavily driven by the interest rates, which drove a lot of buyers out. You combine that with the supply shortage we've talked about a lot on this podcast, and that's where we saw kind of the chaos. As I mentioned, the interesting thing is to look at those two axes, right, on that graph. So as you look at that, you can clearly see that the interest rate has gone up. While the interest rate has gone up over the last year, the index has tracked really far down. So as interest rates have come up, it's basically, you look at the graph and it's basically going two different directions, right? So interest rates are going up and the mortgage applications are going down. Right now that number is into the 160s again, which is actually quite a bit lower, and I may have stolen AJ's thunder on the next graph slide here, but they're tracking very, very closely across the board to a level that now would look like it's concerning, because we haven't seen the level where we're at since like the 1990s.
Like it's the lowest it's been since
The
then.
application rate index right now is about the same point it was in 1996.
What happened immediately after 96? Do we know that? We should look and see.
Yeah, I don't have that off the top of my head, so I will tell the listeners
report
at a later
back.
date.
Because wasn't it the early 90s when they had the
94 was the
94?
Yep.
And so 96
Was the strike in MLB? Is that what you're talking about?
We gotta stop getting off topic in this.
Sorry, I didn't know what you were referencing.
Well, we could do a podcast based around what the 90s looked like compared to right now.
It'd be interesting to know, like, if 96, if we're at the same level as 96, what happened in 97, 98, and 99.
Right.
I know 2000 was a recession, so I'm guessing housing was kind of weird that year.
Yep. So the interesting thing is, so like if we're gonna put a bow on this, right, and summarize where we're at, I would say the interesting thing is we're talking about like history repeating itself, right? So as the markets continue to evolve and change, like in 96, the interest rates were like 7-8%. Now the interest rates have gone up to closer to 7%, and we're seeing the same type of activity within mortgage applications. At the same time, the big difference that I've seen in terms of those markets is the supply side, right? So inventory levels were so high back then compared to where they are right now. And I think that there's a lot of pent-up demand. So in the last year, when the applications were really, really high at unprecedented levels, a lot of those buyers didn't get houses. So they may have already done their applications, they may need to refresh, and I don't know if that flows through the data or not. But right now, there's a large number of buyers that are still wanting to get into houses, and there's still that low supply situation that my crystal ball is saying, well, these numbers are the lowest they've been since 1986, but that doesn't necessarily mean we're going to go back to some sort of housing recession, if that tracks.
The biggest difference was in the 90s, they didn't have pent-up demand from the years prior where people literally just couldn't find a house.
They had
to
supply.
buy.
There was
So if
probably
you wanted a house,
way
you could get a
more-
house.
Yeah, way
No,
more
and that
homes on
makes
the
a ton of
market.
sense.
And they didn't have that big peak beforehand. It was just like, oh, the market just kind
It
of
was just the
slowly
same.
applications, right? But we had a huge spike in applications, and some of those buyers did not get houses. So they're not necessarily
I would argue a
reapplying.
lot of those buyers. didn't
July
get
to December last year was just, I mean,
Brutal.
yeah, they just got wiped out. If they got, if you got pre-approved in like May, April last year, April, May,
I mean, even February.
June, like I'm saying, like into the summer, like the
yeah.
rates were still pretty good,
Yep.
and then they got really bad.
Oh, and so they just decide they're done.
They're
then,
on
yeah.
the sidelines, and that's, I mean, like Josh said, to summarize it, it's so simple. Like if your payment you were comfortable with is this, and that buys you this, and you have your heart set on that, and emotionally you're attached to that, and that's your expectation, then all of a sudden that becomes that minus 600 square feet, or that minus anything nice, or that with old everything, or that in a city I don't want to be in, then people are just like, screw this, I'm just going to go rent in the area that I want to be in. It's a lifestyle thing.
Yeah, and it becomes important though for the agents then to be able to articulate that to clients and say, hey, I know you said that you were going to go on the sideline because when you applied, it was 3.5, and then it went up to 6.5. It's now kind of around 6. We've started the new year. Mortgage applications are low currently, but if it gets to 5.5, those might spike because there's a ton of people like yourself that felt that way.
Yep.
And we don't know what's going to happen. And then you might be in the same kind of situation. Like, hey, the rate's pretty good, but I can't find a house.
Well, the supply situation is still real, right? You can't undo that supply situation. And the other pieces we talk about a lot is how emotional the home buying process is for people and selling. But the reality is if you were emotionally really invested and you wanted to do this, you were pumped about it, you were all on board, you did your application, and then you started shopping, and then the rates skyrocketed, and you got super scared because you didn't know what was going to happen. And then the housing prices kept going up, you kept looking at your payment, and then you just finally got emotionally overwhelmed and stopped doing it. That reality that you were super excited to buy a house versus renting did not go away. Mm-mm. And so there's still enough people that now that maybe rates have settled into a level that they're like, okay, this is just my reality now, and maybe I'll refi in a few years or 3 years, maybe it's possible. But there's just, I think people are probably starting to get that itch again, like emotionally, I kind of want to get back in. And so that's why I say my crystal ball for 2023 is this mortgage application, it's a little counterintuitive to the number, like, well, the mortgage applications are way down compared to any point in history. But the reality is I think that there's still a lot of buyers that are already approved that are probably wanting to get back out there. And so I don't think it's going to be as bad as people think it's going to be.
I think one good question to update too is like, if that did happen, like, do they reapply?
And how does it fall? And I don't have the exact answers how the index
through,
is calculated.
Yeah.
I would also say I know our team is kind of obviously we're micro, right, compared to the entire Twin Cities market, but we have seen a massive jump this last weekend, even in the second week of January, first week of January.
And even if you look at pendings, just as a
turned in 7.
I've seen 6 since last night, but I think we have 4 more coming.
And a couple from the weekend.
Yeah, this week was huge for us.
6.
Yeah, we'll probably be, and that's the thing. We're always tracking at pending sales for our team, and you can kind of take a 45-day close and divide 365 by 45 and multiply it by your pendings to kind of have a better understanding of where you're going to be. We usually are around 30 right now, which I think we're at 30 or 31. And by the spring and summer, we're up to like 75. I think we might get to these higher numbers fairly quickly this year. It seems like, just with what we've been seeing.
Well, and even in our market, right? So pendings got to 40% down versus the year prior. So we always track that number, right? To say like, how healthy is the market right now? We had 40% fewer sales in our local market than we had last year. That was a little discouraging, and that's when people were getting kind of scared. That number has already gone from 40 to 35 to 30 to 25 to 20.
Yeah.
So we're down to 20 now, and I think I would guess that when the next set of data comes out for a couple weeks from now, when we start to see this January plus, I think it'll get even closer to 0.
The issue that we always have, and I think we talked about it a little bit here, is like the technology is what makes this be super imbalanced. That's what's caused this. So like we just talked about a little bit earlier, me and Luke, when the rates really dropped fast, the buyers were immediately in the market.
Yep.
The sellers, on the other hand, are now, whoa, maybe my house is worth more. I should talk to somebody. I should look up, they take their time.
Start decluttering.
Yeah, builders aren't like, all of a sudden, there's not like walls up, spec homes being built the next day.
Well, actually, the opposite is happening with the builders because they freaked out 2 months ago.
And so then now it's like, okay, let's turn the machine back on. So like, I think, and that's why it would be interesting if we got that update from like 96, 97, 98. It probably, you're going to see the impact either way move much faster now than you did then, because even then it's like the only news people had was on the 5 p.m. they get home from work and turn on channel 5.
And the difference is that market was just like they were just chugging along, and that's what the reality of their market had been for 5 or 10 years. Mm-hmm. We're in this like giant peak up, giant peak down, happening so quickly, largely because of this stuff, largely because of COVID, largely because of interest rates. But I think it's not going to necessarily track with 96 just because the market reality of that point was different.
You could argue that based on the 96 data, you could project that it will track similarly with an increase in demand. So like you could look at that and go, we'll probably be about that times, 2.
Yeah, just supply was so different.
That's
so
the issue with the supply that makes it.
You're at 20% of what you had in inventory.
Supply is the issue. I want to get into the script of the week to finish up here. This time you were just with friends. Someone asks you, you're not doing anything. You're
watching the Vikings beat the Giants.
You're watching the Vikings beat the Giants.
And then they ask you the question, you're like, stop talking. Jefferson's running for a touchdown right now.
Mm-hmm.
I need a break. Someone asks you what buyer demand is looking like right now because they're thinking about it and they maybe want to buy a house, but it's kind of competitive, whatever it looks like. How can you use mortgage application numbers to be the expert versus just being like, it's competitive out there or there aren't many buyers?
I always love those answers. it's kind of slow.
People are coming back a little bit though.
How can you use some actual data to be the one that knows what's going on?
Yeah, I would say like one of the main leading indicators that we use is this index from the Mortgage Bankers Association, and we track it based on comparing it to 1990. Right now, it's at its lowest point in 26 years. But that being said, there are some other underlying factors, like a lot of these applications that probably went in 2022 that never got offers accepted. And now we're kind of starting to see the fruit of that since the rates have started to pull back. So, right now that index says demand is very low. I think when you see the next set of data come out, we're probably going to see that uptick quite a bit.
And it's an extremely helpful way. We like to use mortgage applications as an extremely helpful way to understand how competitive a market is likely to be for buyers. So as that numbers continue to come down, we've tended to see fewer buyers, which means you'll likely have more success if you're a first-time home buyer than you've had in 3-4 years, which is still true, right? I'm saying the market's not going to be as bad as it's been, or as bad as people are predicting, but it's still going to be a better market for buyers in 2023 than it was for the last 2 years. It would seem
3 years. Yeah.
3 years, right?
Yeah.
So this data tends to tell that story of like, if fewer people are applying for loans, this index is at a low point. That means that there are fewer people likely to be out there shopping against you if you're going to go buy a home.
Well, and you look at, at least in our local market, the number of listings on the market, we have 1,000 more listings right now than we had last year at the same time. So there's more homes on the market and less applications for mortgages. It doesn't take a rocket scientist to understand that it's going to be a little bit easier than it would have been last year.
Exactly.
And that's all we have today on the Nerdy Agent Podcast. Before we crumple up the papers, just a few housekeeping items. If you have been listening to our podcast and you like it a lot, we would greatly appreciate if you leave us a review, subscribe on YouTube, podcasts, wherever you're listening to this. Leave a review. We'd love that. It'd be great for us to get a little bit more seen in the marketplace, get some more listeners. And remember,
as my oldest child likes to say, like, comment, subscribe when they
like,
finish shooting a video.
That's what I got to hit it on. I got to hit the taglines. And remember, be better.